There are no deals in insurance. There's a reason why it's cheaper. So if you're looking out for policies and trying to find the best price and, where can I get, $100? Well, let's see if I can do 90, 80, 70. Unfortunately, it's not that cut and dry. It's not as simple as where can I just find the lowest premium. So first thing, how do the life insurance companies find out or decide what their premium is going to be? I've already chatted a little bit, some other videos about how they need to figure out the cost based on how much risk they're taking on and how many people are buying a policy with their company. So there's that as well. That's kind of just the actuarial science behind it. But actually looking at you and figuring out how much is your policy, you have a lot more to do with that than all the other people that are pooling money together to get the insurance. So first, with you, it's based on your age, gender, and your health. How old are you? Or the older you are, the more likely you are to die. Okay, so as you age, cost of insurance goes up. Um, what gender are you? Okay, male or female? And the ladies live longer than the gentlemen. So, ladies, cost of insurance, you take the exact same policies with the exact same company, exact same age of a male and a female, exact same health. The lady's going to be cheaper because on average, the ladies live longer. And then your actual health. How's your health? Um, what's your height and weight? Do you smoke cigarettes? Have you used drugs in the past? Are you on any medication? Things like that. Have you had any diseases or anything like that? So, age, gender, health. That's you. Then there's also the type of policy and the size of the policy. So once they look at you, they can figure out the cost of insurance factor, the rate they're going to charge per death benefit for you. So the healthier you are, maybe they're charging like $1 per $1,000 of benefit, and then maybe you're a little less healthy, or you got a higher rating, so they're going to charge $5 per 1,000 of 1,000 of benefit. But then after that, we need to figure out, okay, how much benefit do you actually want, and what kind of policy do we want? So there's three major factors in there. What's your situation like? What kind of policy do we want? And what size of policy do we want? So all those things factor in. Now, just looking at the type of policy, the size of the policy is pretty straightforward. The bigger the policy, the higher the premium. That's very simple. The type of policy matters a lot, and then there's nuances within that as well. So we've got of course, there's term. Most people know about term, and then there's all the cash value policies. So, and then we dive deeper into that, and there might be other riders on the policy. And the riders are actually the biggest reason why you might get situations where someone's talking about, like, oh man, your insurance is $200 a month. Dude, mine's only $180. I'm not gonna pay $200 a month. I can save $20 a month. And hey, who wants to save $20 a month? That's, even in this economy, it's still $20 a month. I mean, that's like that's over one meal. That's a nice meal a month, $20 a month. So depending on where you live, I live in a place where $20 can get you a pretty nice meal. So sorry, San Francisco. So anyway, what was I saying? If you look at all the extra riders on there, you might say, man, this option here is $200 a month. I've got 180. I've got a good deal. Look, remember, there are no deals. There are no deals. You're just getting what you pay for. And the reason why you're just getting what you pay for is because the risk still needs to be covered. It's just that you're not the one covering all of it. You might only be covering $180 a month in my example. But the benefit that needs to be, or the risk that needs to be covered is still like 1 million or 2 million or whatever it might be. So we still need to come up with the same dollar amount. So if you're going to go pay $200 somewhere else, aside from it being a larger company and they're insuring more people, so they're spreading the risk between more people, okay, there is that. But as far as just the raw benefit, the risk is still $1 million. So if you're paying the extra $20, then it's not like you're just getting price gouged or getting screwed over. You're getting something for that $20. Something's being paid for with that $20, as it would be with any industry. Restaurants, going to the dentist, law firms. There's a reason they're charging the premium that they're charging, because there's a certain benefit on there. A lot of people don't know about this stuff. So we're looking at things like, what happens if you get sick but you haven't died? Is a company going to pay the premium for you? We're also looking at things like, what are your options for getting more coverage later? Does the policy allow you to do that? To add on coverage? And if they do allow that, how much underwriting do you have to go through later? Because some options, they're going to let you just get more coverage guaranteed. Some options, they let you get more coverage with limited underwriting. And then some options, they'll let you get more coverage, but there's a time limit to it. Maybe they'll say, hey, in the next 3 years, we'll guarantee you the opportunity to buy more. Or I've heard of some companies where they could guarantee you that opportunity to buy more up to 20 years, 25 years to buy more coverage. So, and if you're doing that, you're going to pay a higher premium. It's just that simple. And then, what else are we looking at? We're looking at conversion privileges. So, term, a lot of term life insurance will have a privilege to break off a piece of that policy and change it or convert it to a cash value policy, almost like rent to own, if you will. So you've got your term, and then you get to take, maybe let's say it's $1 million in term. Let's take 100,000 of that, and now I'm going to make it a different type of policy that's going to last me longer than term. Term is meant to be, shorter term, generally 20 years or less, something like that. Versus cash value policies, they're generally meant to be kept at least 20 years. Maybe on the very low end, like 15. But really, they're designed to be kept for maybe 20 years, or really the rest of your life. 30, 40, 50, 60 years. So a lot of term policies might have a higher premium because they're giving you a temporary solution to your need for coverage should you die young, should you die prematurely. But it's getting your foot in the door to change some or all of it later to something that's going to provide more long-term value or more long-term benefits for you. There's so many. If you get sick, what happens? Can you convert it? Can you get more coverage? What if you're terminally ill? You're not just sick. What if you're terminally ill and you're about to die? Can you get to the death benefit early to try and save your life? Some companies might charge for that. Are there any benefits to the beneficiary? So if you're insured and then you die and your beneficiary receives the death benefit, do they get any guaranteed privileges with that new money? Some companies have benefits like that. A lot of them don't, but some companies have benefits like that, and maybe it's free, but maybe it costs. So there's so many little factors in there, and especially a lot of times with the cash value policies too, since there is the cash value, then we're also looking at what does the growth of the cash value look like. So, is it really good growth rate? Is that company known for providing very good growth on their cash value? Or is the growth really bad? Is it maybe it's a property and casualty insurance company that's they're known for doing like car insurance, boat, your house, commercial insurance maybe. Maybe they're not known for doing life and health insurance. So they don't focus their general account. Talked about that in another video. Maybe they don't focus their general account on growing life insurance cash values. Maybe they focus that on paying property and casualty insurance claims. So yeah, this cash value growth and what if the company pays dividends? So maybe if it's a dividend paying company, I don't know, maybe they charge a higher premium because they want to have more cash on the books to pay dividends back to their policyholders, things like that. Usually that's not a factor, and usually that could be another topic, but maybe the dividend is normally not a factor in the actual cost of the premium. That's just simply a surplus that the company gets. But as you can see, there's so many different factors involved. Some of these policies might even allow you to insure other people, potentially even after the fact, and potentially even with a guaranteed privilege to do that. Maybe limited underwriting. So unfortunately, it's not as cut and dry as, hey, $1 million policy here, $1 million policy here. This one is, $100 and this one's $80. I'm going to take the $80 policy. Take a good look at that policy and see what it's giving you, or what it's taking away from you, rather, for only paying $80 a month instead of $100. It could be a good deal. I mean it could be a good deal, but it also could be. That's a 20% decrease in the premium. That's a lot. So there could be a lot missing there. Most of the time when I'm working with folks who say, I've got this at another company. If it's investments, a lot of that is about the relationship they have with the advisor. But when it comes to insurance, and people say, hey, I've got this at this other company, they're doing it for the price. They're really doing it for the price. And, most people just care about their monthly, right? Most people just want to get that low premium and just get what they need in place. So at the end of the day, I get it with some people. You want to just pay low premium. But there's all those factors in there that really they're really going to matter when something happens. I have a colleague who said, I'm stealing this from a colleague. She said that nothing really matters until it matters. And then that's all that matters. Nothing really matters. None of this stuff really matters until it matters. And then that's all that matters. So, of course, what that means is you're only going to die once. And once you die, you're dead. So, do you want that last check to bounce? And do you want to make sure that your benefit that you got is with a reliable, trustworthy company? Or do you want your family or your business or charity, lovely topic, to be dependent on some random company that you don't know about? Your wife doesn't know about it. Your kids don't know about it. Your parents don't know about it. Your business or your charity don't know about it. Just the cheapest premium you found on the internet. Do you want them to just try and figure that out? And then even when they do figure it out, how long does it take for the death benefit to pay out? You would think that if the Protection is for a situation where it's very cut and dry. You're either alive or you're dead. Okay. You would think that the claim process is very, very simple. Hey, this person died. Okay, great. Send us a death certificate and probably a cause of death. Okay, um, and a cause of death, death certificate, and the ID, and then get us the beneficiary information. Okay, we'll issue a check, and like a week after you send the information in, a week after. Um, you would think it's that simple. But unfortunately, I've heard of death benefits taking, with some companies, taking 2 months to come in, 3 months, 4 months. How dramatically does your life change when someone close to you dies? And isn't that the insurance company's job, is to redeem loss and to maintain as much stability when something happens as possible? Your house burns down. Okay, let's make sure you got a place to live and the house is safe to live in, and we put out the fire as quickly as possible. You got into a car accident. Well, I still need to get around. Okay, get your health insurance. Go to the doctor and make sure you got all your, you got your cast and everything, surgery, MRI. Get that done as quickly as possible. Let's get you some money so you can buy a new car as quickly as possible. And I understand that's a little complicated because it's like, whose fault was it? Is the car still salvageable? No, it's not salvageable. Okay, we got to figure out what kind of car do I want to buy now. You're going to go get another car. If you're dead, you're dead. That's it. So just, insurance company, pay me my money. You know? So you would think that it's that simple, but unfortunately some companies don't pay that easily. They drag their feet and take months, and then you're sitting, then you anyway. So it the you get what you pay for, and there's a reason why it's cheaper. There's so many reasons why it's cheaper. So take a good look at those policies and see what you're getting for your premium. And a lot of times, you just might find that if you're with a quality company with a track record of really serving their clients and paying claims on time, and very quickly, and they have a robust general account, there's that word again, then you might find that sometimes it's worth paying the higher premium.